So, welcome everyone. If you've attended one of these already today, then thanks so much for attending again. If not, very brief bit of housekeeping before I introduce Fran. Do ask questions. There's a Q&A box in the bottom right-hand corner. You can type your questions in there. I will be reading those whilst Fran's talking. Don't be shy, ask a question. No one else can see it other than me. So all questions greatly appreciated. And we are recording this, so you can watch it back later. You'll get a notification when it's available to view, and you can download the slides to look at those as well. So here we are. It's the big one. It's the US. Still the biggest market, despite all reports of other markets stealing some of its lunch. It's still almost 70% of the index, and just completed one of the largest, or the largest IPO in history. So a really important market to get right. And for income investors, it can sometimes be a market that they feel it's hard to access. But actually, when you look underneath the kind of headlines of Mag 7 and the technology growth that we've seen in the US over many, many years, there are a lot of companies that have been paying dividends for a long time. And it is very, very possible to construct an equity income portfolio with some truly world-class companies, and Fran will come on to talk about this, but the trust has a very strong dividend growth record, which exceeds many UK equity income portfolios. So that it can provide a really strong anchor in an equity income portfolio. And so with that, Fran will speak for perhaps 20-25 minutes, and then we'll have time for Q&A after that. And so, Fran, over to you.
Great, thanks, Alan. I appreciate the chat here, and I look forward to speaking with you guys. And feel free to ask questions and have a good dialogue here. But let me give you a little background on North American Income Trust. Many of you are familiar with the Henderson's franchise. This is the Denver headquartered Janus franchise that runs this portfolio. So Janus Henderson, and what's really great about this team is the strength and breadth of the team. A wide analyst team. We have 41 analysts firm-wide, many of whom work on this product to some degree. We have a central research format, and what's very good about this is there's career analysts. So it's not just sort of a young bullpen of analysts, but people who can actually make a career, who don't want to get necessarily into portfolio management, feel very comfortable in their sector. And we have roughly $35-40 billion attached to that with research funds. So there is a dedicated avenue for these analysts. So we do have analysts with 10, 20, 30 years of experience, which is very rare in this industry. And I think that is very useful for a fund manager to be able to speak to the analyst, speak to it on a peer-to-peer level with someone with the same amount of experience. And then when you sort of look down the lot here, the trading team, exceptional trading team, always high quality, great dialogue between the fund managers and trading. And then the risk team. The risk team is very important for us to make sure that there's not any unintended risks that we have when building a portfolio. So I think that the team is something you really can't underemphasize the importance of thereof. And then we just talk about our process here. It's high quality research. We're looking for cash generative companies. We're risk aware when building these portfolios, and the compensation scheme here very transparent, so people don't have to worry about that. Just do your job, and things tend to work out well here for people at Janus Henderson. On the next slide, this is myself and Jeremiah, co-managers. I've been managing this fund since the middle of 2015. I worked with my predecessor manager since 2012 when the fund was converted from a tracker trust. And then Jeremiah joined in 2024, and a great compliment to me. He's great. He has a very strong background in technology and growth stocks, and I have a great background in income stocks. So it tends to have a nice complement to one another, and we work as a team. We talk daily. I joke that I probably talk with Jeremiah more than I talk to my wife. So it's a great dialogue. It's we ask the hard questions, and we do the work, and we hopefully come to an optimal portfolio of a best ideas, 45 to 50 stock type portfolio. And this is sort of an overarching view of the fund. Assets are over 500 million. Dividend growth, which I think is important. This isn't a high dividend fund per se. Dividend yield is over 3%. But more importantly, for us, we're looking for strong dividend growers. And strong dividend growers are born of strong earnings growers. So if we can see strong revenue growth, strong earnings growth, we'll have that strong dividend growth. So it's a true covered dividend. It's progressive. Revenue reserves are over a year, so we have the wherewithal, during periods of stress. I would tell you that we've only had one dividend cut, and it was during COVID. So the track record here is strong. We're not necessarily looking for the highest payout ratios. We're looking for those companies that pay a proper dividend, but more importantly, invest in the business and invest for growth. Because at the end of the day, it's a total return game. It's not just how high can we make the dividend? We can surely make it higher, but we want this to be a strong growth and income portfolio. So a couple benchmarks: the Russell 1000 Value, which has become a little more tech heavy, has some non-yielders in there, but a well-known benchmark. And then the S&P High Yield Dividend Aristocrats, which is sort of proper dividend payers that have a long track record of paying dividends. So those are both decent reference benchmarks to judge us against. Again, I mentioned, best ideas, 45 to 50 stocks, and then turnover, sort of a modest 25 to 50. I think when things are calm, we're probably closer to the 25 side. When things are more volatile, we will be opportunistic and make sort of those hard decisions at times. And, when everything sells off, maybe we can upgrade in quality for that stock that was maybe a little bit more expensive than we preferred. But when we get those opportunities, we'll take them. So we will move turnover when the opportunities arise. And here's dividends and earning growth. I think there's a lot of countries in here, but the U.S. is up there at the top. The dividend growth there has been consistent. A critic may say it comes from a low base. I wouldn't disagree. That's factually correct. But again, we're seeing strong dividend growth in our companies. It's something we measure on every stock every year. We talk to managements about this. Again, it's not the most important part of the business. Investing in the company and investing for growth is important, but that consistent dividend growth is something that is important as part of the process. So, when companies have that strong free cash flow, we want them to invest in growth, but we like having that dividend to sort of keep them a bit disciplined and not have a lot of money where they're sort of looking at different projects that may have inferior returns. We want them to focus on the best projects, and with those surplus funds, after that, pay them back in dividends. And this just shows a list of the dividends. It's, every stock in this portfolio is a dividend payer, but we do have a wide range, and this range is very much will move depending on the value. If high dividend stocks become cheap, we may add a little more weight to that. If low dividend stocks become cheap, in our opinion, we may add more weight to that. But suffice it to say, it's a broad range of stocks. It's very diverse. It's not a traditional income fund that just has utilities and telcos and REITs. This is very much a growth and income fund, and I think that's what your expectations should be for this fund going forward. And here's our dividend track record. We do pay quarterly dividends. The growth rate since the 2012 conversion has been roughly 7%. We just declared our first quarter dividend. Our fiscal year ends in January, so even though we're almost at the mid-year mark on a calendar basis, we just did declare our first quarter dividend, and it was over 7%. So we're continuing that trend. The board is committed to a progressive dividend. The dividend, importantly, has been covered every year. And again, I mentioned revenue reserves earlier, in excess of a year. So we do have a very strong dividend growth profile with very strong balance sheet behind it as far as the revenue reserves. And then performance. This is public information, so I won't spend too much time on it, but good long-term performance. We show both reference benchmarks, and importantly for me as a fund manager, the share price return up top is eclipsed the NAV return. Is the discounts move from sort of a high single-digit range to something closer to a low single-digit range. So, I think it's the story's being well received by investors, and I think that they see that there is another path in the U.S. where you can get growth, but you can also get some income alongside of that. And here's our top 10 holdings. a bit unique. I mean, it's not the seven names you're used to seeing. It's a little bit different. We like the mix here. Again, this is just 10 of 45 to 50, but our top 10 typically are at least a third of the portfolio. Here it's a bit over 35%. So we do have some high conviction, and we look for diversification beyond that. So, but needless to say, some interesting names here. And I'm going to go deeper dive into a couple sectors just to show you, a little bit further underneath the hood. But again, a different list of names than you're probably used to seeing. And here's some attribution. We're always transparent with performance. We'll always show our top performers, our bottom performers, and then we'll sort of show our sector weights and how that's contributed. A couple things I used to like focus on the outliers. We'll start with the bad news first. When we look at our bottom five, Micron is down there. It's a stock that's gone from 100 to 1100. The dividend is 5 basis points, so it's really not part of our remit. It's part of our benchmark. So that's, shows as an outlier. We do own Zoetis, and that's one that it's a small holding. It's been a bit disappointing. We're keeping this. It's a good, interesting name. It's animal health. It's a pharmaceutical for animals, and it's a small holding, but we feel confident there, so we're keeping that for now. And then at the bottom, Philip Morris has been a holding, since day one in 2012. And again, when the market goes, up quite quickly, Philip Morris tends to lag, but we like this as a long-term compounder. And then on the top side, a mix here. Each successive month, more recently, it's a little tech heavy, but we do have some AI and AI infrastructure names with Lam Research. We have Dell that's participating in this as well. Berkshire is actually a non-holder, so I don't want to take credit for that. But Berkshire, interestingly, has a lot of end markets that look like our end markets. So whether it's power, whether it's utilities, whether it's insurance, whether it's railroads. If Berkshire's ever in the top five or bottom five, it's really not a bother to me because we do capture the end markets there, just not in a diversified form in Berkshire, which does not pay a dividend as well. And then Citigroup at the bottom, which was sort of a more value-y name for us that we have owned. We've actually just exited it, sold that on strength and traded up in quality, we believe. Again, a tough decision for a stock that has done very well for us. But again, still a top five contributor. If you look right beneath that, which you can't see, there's some healthcare names. So it is a pretty wide list of stock contributors for this fund, and we feel very good about the outlook here. And speaking of the outlook, just a little on the macro, and I know I tend to get a lot of questions on the macro, and if what I'm reading in the FT is true, or maybe let's go to the next level. But like any good president, midterm elections are coming up in a handful of months here, and presidents prime the pump. And I show 4 different levers that they're using to I don't want to say flood the economy with money, but sort of add a nice backdrop. So, we're looking at GDP despite the Iran war, despite higher gas prices. We're looking for GDP of least 2%, and we're seeing strength very broad-based. We saw earnings in the first quarter over 22% with revenues up 12%. So the economy is pretty strong. We're looking for similar earnings profile in Q2. And then the back half of the year, maybe a bit of a fade, but again, very confident in both the sales and earnings growth. And the Fed, and tariffs and fiscal is a little bit of a tailwind for these companies. So very good. And I think what's important here is fiscal policy. If I were to circle something that's more long lasting, the fiscal policy, the bill that was signed into law last year provides, immediate expensing of capital. So why is that important? The U.S., over the years have, been accused of underinvesting in their businesses and just buying back stock. I think right now what we've seen is a CapEx boom, and it goes beyond AI and data centers. We're seeing it across all sectors. I think that's important for the long-term growth of the U.S. economy. And now you have a fiscal benefit behind that. So something that's very structural in nature, and I think is going to provide a good runway for the U.S. in the coming years. And then Kevin Warsh, Fed chair, is Trump going to jawbone and make him lower rates? I think Warsh is a very strong candidate here. And now he's in the chair seat. And I think that he's going to run this like a proper businessman and not a politician. So yes, the guy on the left has some sway and there's some rhetoric, but I think Kevin Warsh is going to be looked upon over the years as someone very credible, very transparent, and really focused on what's best for the country over the long run, not a short-term phenomena. And then this is an interesting slide. It's probably not fully appreciated by many, and it's maybe not in stock prices per se, but the Mag 7 has had a tremendous run in earnings. And when you look at earnings in the back half of the year, we actually see the 493 actually outgrowing the Mag 7. There's a bit of a lull of large numbers for the Mag 7. The Mag 7 has spent a lot of capital on growing the business. Some of these formerly capital light companies are now capital heavy, and you see depreciation coming in and flattening earnings for some of these companies. But if nothing else, the earnings picture is broadening in the U.S. I think that puts our fund in a very good position here longer term. And then the portfolio, it's high quality companies. These are cash generative companies. Again, we're not looking for the highest dividend yield. We're not looking for the highest payout ratios. We're looking for growth companies that pay a proper dividend and companies that we can theoretically hold indefinitely. We're not looking for companies to grow, 10 or 20% this year and try to trade those stocks. These are very much, high quality, high returning companies with a proper management team and proper incentive structure to continue to grow this business for the long term. And then a little deeper look under the hood here, financials, a lot of names here, but I would tell you a fairly diverse group of holdings here. The one place where you will see some duplication, Morgan Stanley and Goldman Sachs. So we've been aggressively overweight capital markets. And Morgan Stanley and Goldman Sachs obviously give us almost a pure play to that. We've been trimming a little bit of that into some strength, but needless to say, still a strong holding. We feel very strong in the capital markets. Obviously, there was a big IPO, and there's a couple big IPOs on the come here, but the capital markets are very healthy. M&A is at peak levels. And then interestingly, on the private equity side, some of those portfolio holdings have not been sold yet. So there is some latent, powder here for these capital markets to continue to do what they're doing and doing well. But again, a broad mix, and we can talk about any of these names if needed. And then in healthcare, another big sector for us, and again, a pretty diverse list. It's not just four large cap pharma companies that pay high dividends, but CVS, which is insurance. They do have a retail pharmacy footprint. Again, broad-based. Johnson and Johnson, we know the pharma side of that, but it also has a very big medical device business. Danaher, which is tools. Abbott Labs and Medtronic, more on the device side again. And then we have a couple more classic large cap pharma names with AbbVie and Bristol Myers. And then I mentioned Zoetis earlier, again, animal health. And then sector snapshot, North American Income Trust is the yellow bar. So it sort of shows where we are. We're well diversified, but we're willing to make some bets off benchmark where we see value. Blue is the Russell 1000 value, and then the S&P Dividend Aristocrats in green. So it just shows a little bit of the bets we're willing to make, and we feel very confident in this broad, diverse portfolio that, again, growth and income. And then performance, this is discrete performance on a year-by-year basis. Again, public information, so I won't spend too much time on that. But again, we feel very confident in the trust going forward. Where does Nate fit? I think, for investors like yourselves, I think this is really the ultimate question. We're showing you that there is something else beyond the Mag 7. Again, but it's not just a high income, high yielding portfolio, very much a growth and income portfolio. I showed you a different top 10 than you're probably used to seeing. And I think that when you look at this, it's a very good core holding for people who want to participate in the growth of the U.S., but also have like that quarterly dividend check that's growing 7%. So, roughly 2 times inflation, arguably 3 times going forward. But we feel very good about that. Longer term, we feel like the companies and the wherewithal and how we project dividend growth, again, can meet that sort of high threshold of mid to high single digit dividend growth. So again, that's the portfolio. I'm going to turn it over to Alan and open it up for questions, and we really appreciate your time today.
Thanks, Fran. I'm going to start with a question of my own, and in so asking, reveal my age. But going, as you said, the top 10 is a list of companies that investors aren't always used to seeing. And the last time I encountered Texas Instruments was a calculator that I had at school, and
Yeah,
so I was just going to ask, tell me about that, and maybe pick a couple
yeah,
of other companies in the top 10, because I think that kind of gets to the heart of this, that it's really different
yeah,
to the
yeah. The
not
Texas,
necessarily to your index, but to the
yeah,
S&P 500, which everyone
yeah,
is
yeah,
familiar with. So
absolutely. No, I think Texas Instruments is an interesting company. It's analog semiconductors. So it's not the highest technology out there. It's not cutting edge, but what they are is very important. It's very much an important part of the industrial economy and the automotive economy. Less on the personal electronics. They do have, there's still Texas Instruments calculators out there. Um, but if you look at the bulk of their business, it's industrial and it's automotive. And I would tell you the automotive is still very much in a recession here with higher interest rates and cars lasting longer. So again, there's some latent earnings power there. They spent a lot of capital the last several years building out their fabs for domestic production. So we feel very good about them. Capital intensity is now lowering, free cash flow is rising, and very much a well-managed company that manages their business for the long term. Their capital expenditures the last few years, a lot of public companies would not have done that because it flattened earnings a bit, but they did it thinking with a 5, 10, 20-year view. And I think that they're now coming out of that very well positioned. They do have some data center exposure. It's less than 10%, growing at a high clip. So I wouldn't put this in the AI infrastructure camp. This is more a classic industrial technology company, slotted as a technology company, very high quality, very cash generative, high margin business. So that, that's one of them. If we go back to the top 10, I had Lamar Advertising in there. The exact opposite. These are the billboards you'll see driving your car. Um, Lamar has dominated sort of what we would call B and C markets, so sort of more rural roads, um, very high quality management team. And part of their growth story now is converting the old wooden billboards to something digital. So instead of having, one person, one company on that billboard, you now have four, and you can go throughout the day. And the example they would give is you could have the person selling coffee in the morning, maybe a financial services company during the day, and maybe a fine dining place in the evening. So the digital business gives them more growth, more profits, more margin. It involves a little bit of capital, but not that much. Um, Very cash generative company, dividend yield that's strong and it continues to grow. It's in excess of 5%. And just something that's typically not found elsewhere. So company that we own as a firm fairly broadly. So, a little bit of that. And then, Chevron is up top and what I would tell you is there's a lot of energy companies in the U.S. We only own two of them. We own Chevron, which is a wide, diverse company. They obviously have some oil correlation and some natural gas as well, but they also have refining, they have marketing, they have chemicals. So it's sort of an all-in-one stop shop, one stop for all. But we feel good about that. We feel the value's not there versus trying to synthetically build a Chevron with a refiner, with an E&P company, and with a chemicals company. We actually feel that this gives us a nice blend. They're very good at allocating capital. I got to meet with the CEO on a very, on a one-on-one basis recently and just able to understand what he's thinking. They have a toe in Venezuela, sort of a free call option there longer term. But again, very well run company, well disciplined with their capital and sort of a core holding for us.
mm. And there's some other questions on, unsurprisingly, on valuations, which I'll come on to in a sec. But I was just going to finish by asking Enbridge. I think some of our
Yep.
viewers will be familiar with
Yeah, Enbridge is
that.
our other holding.
It's a
It's
Canadian company, isn't it? And so I just
it's
wonder whether
yep.
there's any implications from the the uh, the US Canadian um, relationship, because it's
Yep.
pipelines across the border, isn't it? Well,
It's
part of it
pipeline.
is.
So it's very much a toll taker, highly contracted, high quality business. They also own a few utilities. So if me and my analysts were here, we would look at it as maybe three-quarters pipeline, toll taking, fully contracted, very predictable revenues, and then one quarter utility. Again, predictable revenues, different business model. Um, But we just sort of like what they're doing. We like the capital allocation. We like the discipline. Um, a mid-single digit grower, so it's not going to be the fastest grower in our portfolio, but very consistent, very predictable. When we look out 5 years, it's probably one of our easiest companies to model, where we see that mid-single digit dividend growth, that mid-single digit earnings growth. So again, there are U.S. companies that do similar. We feel very good with Enbridge, so it just shows that we will look across. We'll look to our neighbors to the north if need be, and because they're in energy infrastructure, it's really not as impacted as other sectors may be, such as financial services or whatnot.
Yeah, yeah. Okay, so let's come on to valuations because it's very difficult
Yep.
to read any paragraph about US equities without that word coming up. And I think everyone watching this will know the kind of concentration. But do you want to talk about valuations, contrast valuations that you look at, and maybe even if you can provide some kind of context with perhaps the UK and Europe, which are obviously for an equity income investor, are other sources that
Yep.
they might look at.
Yeah, no, it's usually the first question I'm asked by many. Someone will look at me, why the US? It's expensive, and interest rates aren't zero anymore. So, which is important. So the discounting mechanism isn't zero, it's something higher. So, terminal values are thus lower. So I think importantly, if the US is on 22, 23, 24 times, pick your number, forward earnings, we're not there. We've been between 15 and 17. We're somewhere in the middle right now, 16, 16 plus. So again, we're not looking for the cheapest companies. We're looking for companies that are fairly valued. And we've been able to find a bunch of companies that we think net out to, well, it nets out to 16 odd, but I would tell you, we have some 10 multiple companies. We have some 25s in there. This sort of the bell curve. And it sort of nets out to 16. So we think we have a nice degree of safety. I would also say just because you own companies that net out to 16 doesn't mean you automatically outperform in a down market. We got a little test yesterday with the market down over 100 basis points. Um, the NASDAQ down even more. We were actually flat to up yesterday. It's one data point. I'm not going to overstate it. Um, but needless to say, we like that element of safety in our portfolio. We feel very good about it. Um, but again, we're looking for growth. We're looking for, we're modeling double-digit growth in this portfolio. So, we're paying 16 times for double-digit growth. It's not again, utilities, REITs, and telcos that are lower, higher yielding, lower value. These are growth and income companies. So again, we feel pretty good. That's where sort of our sweet spot, and there obviously are ways to get 25 and 30 and 40 and 50 multiple companies in a portfolio. This portfolio sort of stays in our lane. We do what we say we expect. And again, growth and income.
Yeah, and there's a question relating to kind of turnover and what's the signals for buying and selling, and I'll just wrap into that. In the UK, if a company is looking at cutting its dividend, it's a big decision to make, and everybody knows a dividend cut will, even if it's a well thought out one, is likely to impact the share price. How important is it in corporate decision making in the US for those companies that have got that kind of long run
Yep.
dividend profile, and then what causes you to sell, and how much turnover do you have, and what are your sort of signals you look for to initiate a position as well?
Yeah, no, these are all good pertinent questions. I think when we look at turnover holistically, I gave earlier 25 to 50 is sort of our range. Um, the 50 tends to be in more volatile times, but again, it's very much a bottoms up decision. So if we have a company, that doubles in value and we don't see earnings, requisite, that doesn't provide that same value that did it at initiation, we may sell it. We're only looking for 45 to 50 stocks. We're not looking for 75 or 100. So I would tell you as a fund manager, and I'm smiling, it's not easy to sell stocks that have doubled and tripled because there's proof points there, and they're usually good companies. But we need to be disciplined, and we need to just stay true to our valuation. and our dividend goals. So, those are some of them. But we also have stocks where fundamentals have changed. And we owned a company, Booz Allen. It wasn't a big position, but sort of a consulting business that went against the government, or leveraged the government a lot, and it sort of was, the government is obviously, well, obvious to probably many, not the most technologically savvy company or business or entity. So having consultancies, bringing them closer to reality is important. But during Doge last year, they got cut back pretty aggressively. It was probably penny wise, pound foolish. But needless to say, it was one where we thought visibility was low and we sold at lower levels. So sometimes that happens. It's not all stocks that double and triple and we exit. So a little bit of both, and those are humbling. So those are also hard decisions because, as a manager, falling into a value trap is probably the single biggest risk when looking at a manager. It's easy to say, oh, the stock tripled, let's sell. But when stocks go down 20, 30, 40%, and you bought it at 100 and you're selling it at 60, it's not a great feeling, but you need to do that sometimes. And I think, between Jeremiah and I, we'll bounce ideas and sometimes we just, throw our hands up and say, you know what, we're not going to have thesis drift here. We'll take our losses and we're going to find something better. And so that's, one way, we'll do it. And you have to beat that discipline to be successful over time. So, that's sort of how we do it. And then on the initiation front, typically these are high quality companies that may be out of favor. So whether it's, a retailer that we recently initiated that was sort of out of favor, when peers are trading at multiples much higher, that we think that they have a similar growth profile, maybe a touch less, but trading at half the valuation. So companies are out of favor, but have good bones to them, have good management, have maybe a change agent if a change agent was needed. Um, but sort of, doing that, maybe getting paid 2, 3, 4% in dividends while we wait for that inflection point, knowing that it's impossible to just sort of pick the inflection points. So again, high quality companies typically out of favor. That would be a classic initiation for us and something that, we can be patient with. You wouldn't want to have 10 or 20 of those companies in a 45 to 50 stock portfolio, but a handful is usually a good starting point. And those stocks tend to rewrite quickly if and when our thesis plays out.
And there's a question about risk and how you look at risk. And I suppose with a 45 stock portfolio, one thing we can say is that you're not measuring risk against the composition of the index, or at least it doesn't seem to be the dominant factor. So how do you assess portfolio risk?
Yeah, so I did mention our robust risk team. We get monthly reports. We can obviously get ad hoc reports on any day. And I would tell you the number one risk in this portfolio is dividend yield. We're overexposed to dividend yield. So our dividend yield of our underlying companies is roughly 3%, again, growing 6, 7% on average. US indices typically don't have that. The Russell value dividend yield's roughly 1.6, 1.7 now. So, we're almost double that. So that's a risk. It's not a classic risk, but we want to be careful of interest rate risk. If we own some banks or we own some REITs. So we're owning those, knowing that going in, but we don't want to wake up one day and realize, rates roll over or rates shoot up and we underperform because of that. Even if we like those underlying companies, maybe we need to manage position sizes a little bit better. That would be a classic conversation with the risk team just to sort of go over that. And whether it's currency related, whether it's a currency mismatch. As a growth and income manager with a valuation discipline, momentum tends to be a negative risk. We don't, we have stocks and we'll let stocks, grow as we see growth rates grow. We'll raise price targets if applicable, but typically we tend to trim back our winners a bit. So a little bit of a negative momentum slant would be something on the other side of the risk continuum. And obviously sectors and stocks, risk, because it's 45 or 50 stocks, our average position size is something north of 2%. It may be a small weight in the benchmark. So there are some stock specific risks, there's some sector risks. And again, we're willing to build a bottoms up portfolio. And sometimes we're sector aware from a risk perspective. But if we see value in certain sectors, we're more than willing to take those bets in a careful, controlled manner.
And that, I think that leads on to another question, which is that, in terms of marketing, at least, the Dividend Aristocrats Index has got a good name.
Yeah.
And but there are passive strategies that kind of, superficially provide the same kind of exposure, but you're very different to the index. So what are the if you bought the index, what are the risks that
Yep.
you wouldn't experience if you bought Nate?
Yeah. I think what I like about Nate versus the aristocrats is it's a more diversified portfolio. If you look at the aristocrats, sometimes it's heavy in utilities because utilities can sort of raise rates every year, so you get dividend up every year. So it tends to be a little bit overweight utilities. It'll be underweight some low yielding industrials that have low payout ratios, perfectly good companies. Um, and then consumer staples, companies that again, slow growth can raise their dividend every year. So you get a little bit of a sector mismatch. So I think, for us, we have a comparable yield, but sort of a faster growth from both a revenue, earnings, and dividend growth. So that's probably the biggest point of differentiation. Again, you can, get a similar yield, through an ETF, using that. But I think we like our combination of growth and income. So I think we could get comparable income with faster growth, higher return on equity, higher return on invested capital. That's sort of the crux of our portfolio here.
Mm. And then going back to that really interesting slide you showed on the kind of rebalancing of earnings
Yeah.
growth, I think lots of people have seen that incredible graph of capex in the US driven by the hyperscalers, we're now calling them. And do you want to just talk a little bit about what happened? Because I think we've discussed this before, Fran, that there was a kind of hiatus in capex elsewhere in 2025 whilst that was going on, and then further, that extraordinary capex is going somewhere. It's going to somebody. Is it going to people? Is
Yep.
it going to companies in your portfolio? Because is that one of the explanations for the green bars now picking up, that they're now in receipt of some of that money?
Yep. No, it's an obvious question. Obvious question. A lot of capex. We know the quantum is numbers that are almost unquantifiable or unthinkable to history. Um, and when you look at AI and data center specifically, and I don't want to say this in a trite fashion, but we have some picks and shovels types of companies. So whether it's Lam Research, which is semi-cap equipment, whether it's Amphenol, which is connectivity, we own Train Technologies, which is HVAC. We own company Eaton, an industrial company, that has power. And then I mentioned Texas Instruments earlier, which is nascent, but has some chips going in that business. So, again, we're looking, and when you look at those companies I just mentioned, it's just a part of their business is leveraged to the AI infrastructure play. So, we sort of get it that way. So when those guys are spending, our companies are recipients. So that's been good. We also need to be careful of the risks. When CapEx, if and when it slows down, are our companies overexposed to that? They tend not to be from an earnings basis, but from an earnings growth basis, that tends to be their fastest growth. And obviously, this is where valuation comes back into it. Are we paying fair prices for these companies? So, we've been trimmers of Lam Research specifically. We've been trimmers of Dell, a couple companies, Amphenol, slight trim there. So, we've been pulling back, but the weights have been increasing. So sometimes it's sort of, running to stand still, if you will. Um, but we need to be a little sharper on those names because when the music stops, if it stops, those names tend to be vulnerable, even if the earnings impact isn't as great as one would expect.
Yeah, and then there's also been a phase, hasn't there, in markets where investors have been reassessing the quality of
Mhm.
businesses, and software as a service is the one that everyone's alighted on. Have you had cause to reassess any companies you own, and have you had cause to reassess companies that perhaps have fallen into your index, or
Yep.
fallen to attractive valuations as a result of being reappraised by the market.
Yeah. So we don't have a lot of software exposure. Partly, most of those companies aren't big dividend payers. But we bought earlier this year. We thought we bought it cleverly. We bought into it. We thought that one was not going to be disrupted by AI. We still believe that. The market does not believe that. So that would be a position where, we start with a typical starting position for us is maybe 75 to 100 basis points. That position's down to roughly 60 basis points now, so it's underperformed. We're evaluating it now. We've been evaluating it before we owned it, since we've owned it, and going forward. And again, is it one of our 50 best stocks? We'll find out. But right now we hold a small position there. It's the software companies. I think we know the story here with AI and the value of a software engineer, the price compression, the margin compression, the negative operating leverage, that nets out to. So those businesses are challenged. We think that there'll be winners and losers there. Sort of commodity software, easy to say, but those companies obviously most at risk. If you're a small business, do you put your tax and compliance away from Intuit to an AI startup? I don't think so. We're still modeling Intuit growth double digits for this year and next year. But the market's derated that stock to roughly 10 times. So it's something that we're obviously aware of. The market's the market. We haven't added to it yet. But we also haven't exited. So it's something that we're just sort of standing still right now and just sort of carefully evaluating. It's, again, small position, 60 basis points, smallest position in the portfolio, quite honestly. But that would be our exposure there. Again, not a lot of exposure because there's not a lot of dividends there, but something that needs to be asked, because software, people liked it because it was capital light and recurring revenues, and those things still exist, but the cost and the AI ability to disintermediate software engineering is something that was probably not expected a year ago and certainly not 2 years ago.
Mm-hmm. And I'm going to just come round to some more Nate specific structural questions, and if you could just go through the components of the dividend and how that's generated, and then also just talk a bit about the kind of safety net against discounts. I mean, Nate, as you mentioned, the discounts narrowed quite a bit, so it's not currently a particular issue, but Nate has a few mechanisms in place to protect against future discounts, doesn't it? If you want to just run through those.
Yeah. I think when the dividends, and I showed a slide earlier, and I'll bring it up, having me multitask here. But we have a wide range of stocks that pay dividends here, and I would tell you, if you were to look at sort of the faster or the higher yielding companies, tend to be a little slower growth. Dividend yield growth there is probably low to mid single digit. When you come over this side, the lower yielders tend to be double digit, 10 to 20% dividend type growers. That's what sort of nets out to that 5 to 7 range, and again, 5 is probably conservative. We just paid our first quarter dividend, or just declared it at 7.1%. So it's a mix. We're not managing to 7% growth. We're managing to a total return number, and that typically nets out in that 6 to 7% range. So again, very comfortable, very predictable. When I start the year, I can tell you, dividend growth, if the portfolio were static, if turnover were zero, I can give you a very good number of what I expect dividend growth to be, very predictable. Because again, these aren't the highest payout ratios. These are very comfortable payout ratios for these companies, and the growth's fairly predictable because we're not looking at no growth, low growth companies. We're looking at sort of, mid growth, proper growth companies. Not the fastest, but not the slowest. And then from a discount mechanism, I think it's been extremely important the last year or two, as we know, with different activist investors. I would tell you in 2024, we bought back 10% of the company. So the board's very committed to that. And then in 2025, we bought back another 7%. So, we want to grow the portfolio, of course. But when the dividend gets high, and high being 7, 8, 9, 10%, 11, 12, we're willing to buy back. We bought back a little bit of stock a week or so ago at 6%. So again, very committed to defending the discount here. We feel there's good value in this portfolio. And I think the thought is over time, we think this is a pretty good mousetrap, and we think that this portfolio has the ability to grow, and buying back stock at 94 cents on the dollar, 92 cents on the dollar is a good use of capital and move that make both of this portfolio vibrant.
Great. And there are even some tentative signs in the investment trust sector of some issuing shares again. So who knows? Off the back of this presentation, maybe you'll get an order. Thanks, Fran. That's a really good comprehensive tour of the portfolio and US markets from a very different perspective. I think everyone looking at this presentation would be pleased to learn something that didn't involve the Mag 7 with what is, as I said at the beginning, still the largest equity market and a really important one to get right. So it's been really informative. Thanks everyone who's on live. I did ask Fran yesterday if he'd talk about air conditioning and ice cream companies, but he hasn't. So that's a fail. But
Next time,
maybe
if I get invited back.
But he's luxuriating in air conditioning in the US, whereas some of our viewers probably aren't. So I think we can forgive you for that one. As I said, this is recorded. You can always email us with any questions that didn't get asked or answered later, and you can also download the slides shortly to have a look at some of these charts. Thanks everyone, and hope to see you again on the next one.